So this is a review of the Indian equity markets for the year 2025. And what we see that volatility remains an important factor during the year. That has been the essence for the entire year. So we analyzed the volatile months between 1990 and 2025, when we found that there are two clusters of month. It is largely during the March period. It is also the quarter ending, and for both the calendar year and the fiscal year, this is a quarter end, and then we have a very specific period between August, September, and October, which remains volatile. And this is the last 30 years data. We have mapped all sorts of wars, all sorts of economic crashes, all sorts of currency crises in this one. For 2025, we found that first half was not that volatile. There were absence of events also. Second half, which is H2, saw a lot of events, which included conflicts between major countries. There was also an interest rate cut from the US Fed and India, obviously. So the interest rate decisions were taken. Bank of Japan, in both the counts, has increased the interest rates. So between August and October, there's one bucket here, the second bucket, namely. The third bucket is obviously December, which kept the markets volatile. So economic front, so interest rate decisions, liquidity, money supply, and wars kept the markets volatile. How has the FIIs or FPIs, as we call it, performed in the cash market? So they have been seller throughout the year. They started by selling in the first 2 months, January and Feb. So they were aligning on the interest rate expectations. So when the interest rates are expected to remain high in the US, they sell the emerging markets. So that is how they started. Couple of months they bought, but they resumed selling, especially in July, August, and September. August seeing one of the highest selling. It was largely on account of the tariff threats that were given by, or that were announced by Trump, and then eventually implemented in September. November and December has seen resuming of selling pressure. October was the only month in between which saw that some of the buying came in from FIs. Possibly they were realigning the portfolios on account of GST rate cuts and also the festive season mood. So now if you look at product wise, the FPIs have continued to sell equity. So on a net basis, they've been a seller that has borne the maximum brunt there. Debt products have received fund inflows on a net basis. That means FIs were clearly sort of focused on locking in the interest rates because they had some understanding of the interest rate scenario for the full year, and they continued to lock in the interest rates before the interest rate cut on the debt front. Now, if we map the months, India-Pakistan tension did not lead to any FII selling. In fact, FIs continue to invest in the Indian markets. It is largely the August Trump tariff shock which has led to huge selling. We also saw that Bank of Japan, the absence of carry interest rates, which is not good for the American markets, but possibly good for the Indian market, because Indian markets, emerging markets, will receive funds, and we have seen that the FIs have sort of reduced their selling when Bank of Japan first decided to cut the interest rates for the first period in October, and that sort of reduced the selling pressure. The year-end volatility has seen some sort of year-end booking has seen some sort of FIs continued selling. Here, RBI has decided to cut the interest rates. Bank of Japan has increased the interest rates. So, but rupee has come under pressure here, and that it's largely because of the FPI selling. And for them, January to December is a calendar year, so possibly the December year is a month when the book closures are happening, and that has seen a lot of selling here. It started with a global risk off scenario with Fed expected to have higher interest rates, which led to the selling. As the risk eased off, FPIs continued to sort of reduce their selling behavior. But August is one period, the tariff which really hammered the expectations, and FIs continue to sell because of the tariff pressure. If we look at the sectoral trends, there are more number of sectors which are in green. The last 1 year performance from today, which is December 19th, if we look at backwards 1 year performance, you'll see a lot of sectors are in green. The few sectors, especially the telecom, the software, the hotels and resorts, which have not performed. So, and transport and hardware technologies and banking and financial sectors, including automobile, have given good returns, anywhere from 20-odd percentage to 100% also. But let's look at the microstructure of those buying behavior at the sectoral front. So this is again a plot where we said there are more number of sectors which are ending in green this year versus a few sectors compared which will be ending in red. The top performance are the transport and hardware technology sectors, 109% from transport, and about hardware technology giving about 83% odd returns. That's a significant returns here. The bottom laggards have been telecom and equipment and IT services also, which have given anywhere from 15 to 20% odd negative returns. This is a mapping of the sector, with transportation doing the best and telecommunication performing the worst here. But if you look at the advanced decline ratio, for every sector, you will see that the advanced decline ratio is below 1. So what is the meaning of advanced decline ratio below 1? If one advanced decline ratio is greater than 1 for any particular sector, it means there are more number of sectors, stocks which have outperformed versus declined in a particular sector. But here the story is different. For all the sectors that you look at, the advanced decline ratio is less than 1. That means there are only few stocks which have performed. The rest of the stocks, so within each sector performance, within each sector that has given you good returns, there are only few stocks which have performed. The rest of the stocks have not performed. So majority of the stocks have declined. What could be possible reason for that? So on the transportation side, we see a strong cyclical demand. We see infra push. We are also seeing operating leverage work in their favor. The hardware and technology segment is largely reviving on account of the capex cycle, the electronics manufacturing push, which is from the government of India, and also the supply chain realignment. The telecom services sector we are seeing here is not performing, and also along with tourism and IT services, they remain under pressure. And there are also some global related concerns and rate related concerns and currency volatility, which has led to the decline. So this is all for this year. We'll meet again with a similar kind of market outlook for the next year as well. And thank you.